Okay, so we're back here with Mako Mining with Mr. Akiba again. Short notice, only like 6 weeks ago since the last update, and we went through all the other assets. Then so you guys can go back and take a look at that if you have not. Should be quite up to speed still. But he has acquired another asset, or at least the intent is to acquire another asset here. It was announced end of September, and moving fast, impressive. So I thought we might, do our best to at least convey a bit more than what has been stated in that press release, just to hear your sort of high-level thoughts. And you're going to release a technical report, I take it, quite soon, in a couple of weeks, and then we have some more substance. But at least people are hungry for information, so let's do a bit of a conversation and go back and forth there. So, Akiba, maybe you can start with just in your own words explaining the deal structure again, and you don't need to. Go on a big tangent on related party transactions. Some people don't like that, but I think we're past that at this point. At least I am.
Yeah, no, I mean, at least on the related party stuff, it's a big component of Mako. I mean, the way that I always like to describe it is that we have two distinguishing characteristics from most junior mining companies. The first is that we have this controlling shareholder, where it really functioned in two big aspects over the course of the last 6 years, since Mako became Mako when we took over the management and the board. The first was making sure that we were shepherded through the doldrums of the bear markets, and making sure we attempted to set our portfolio and make the company ready for the bull market, and doing it in a way that didn't blow up our capital structure. And they were essential to do that. The other aspect became much more relevant on the last two acquisitions between Moss and now Mount Hamilton, where they were part and parcel for the tactics on how we were able to acquire the assets as cheaply and efficiently as we did. So Moss, obviously, being in the background through bankruptcy that we went over in detail on previous sessions, and then over in Mount Hamilton through the structuring of this. And then the other distinguishing characteristic of Mako is the fact that we have our own internal engineering group, which was set up with the specific intent back in 2019 to actually run a portfolio of small and medium scale projects and mines within the Americas. So junior mining companies generally have two paths. None of it's not a bad good analysis. It's just it tends to be the paths that they choose. Either it's an exploration company that's trying to advance a project to eventually sell it to a larger company, or to the extent that there is a team that is focused on getting an asset into production, it usually is a team set up to focus on getting a singular asset into production. From inception, we were set up to be running a portfolio of this, having both sides of the same coin kind of working together. Now, with respect to Mount Hamilton, this was a project that we initially tried to acquire back in 2014. There's a long backstory on why we were rebuffed from that transaction in 2014. But one of the previous owners was loosely affiliated with the predecessor company of Mako. So they did have a full feasibility study put on this by SRK when that group, a joint venture between Ely Golden Minerals and Solitario Resources, got that up and running on the feasibility side. They got it fully permitted for construction in 2014, and then it was sold in the second quarter of 2015 to a private equity group out of Canada. I was extremely upset that we missed that opportunity. In fact, I actually had to fire for cause the previous management of one of the predecessors of Mako because of this transaction, but kind of went through the cracks. And then early last year, I woke up to a press release that Waterton was attempting to vend this into a private company unrelated to us. And obviously I got really pissed off at that as well, but nobody to blame but myself on that one. Almost immediately, I tried to insert myself into the process, working with that private group for over a year in one form or another, which is where we finished our diligence on that. That particular private group really couldn't get out of their own way. They couldn't negotiate with us. They couldn't negotiate with Waterton. They wound up defaulting on that option agreement about 4 months ago. And then 5 days after that happened, I approached Waterton with a take it or leave it acquisition proposal to acquire this for US $40 million in cash. And as you alluded to on the structuring side, this was intentionally structured in a complicated manner for the benefit of both Mako and the affiliated royalty companies, Sailfish's shareholders over here. So Mako is not the one that's initially buying this. Sailfish, and for your viewers who don't know the full extent of the relationship, so I'm the CEO of Mako Mining. We have a controlling shareholder named Wexford Capital that owns 48% of Mako. I'm the executive chairman of this affiliated royalty company called Sailfish Royalty Corp. Where there's also one other common board member between the two companies, and then Wexford owns 70%. So that's the main form of affiliation. There happens to be a relatively small scale royalty relationship on the back of Mako's Nicaraguense mine, San Albino, and Sailfish. But the vast majority of Sailfish's net asset value happens to be a royalty completely unaffiliated with Mako. Coincidentally, it happens to be a royalty on one of Waterton's other projects called the Spring Valley project, which is a fully permitted 5 million ounce resource, 4 million ounce reserve in Nevada that's going to be in construction imminently. Now, the way that the structure worked is that Sailfish is buying this for $40 million in cash. Sailfish is taking a US $40 million bridge loan from the controlling shareholder Wexford to fund that. That part of that transaction I expect to close in pretty short order, let's say for argument's sake, about 2 weeks from now. That bridge loan will be repaid through the sale in part or in whole of Sailfish's main asset, which happens to be this royalty on Waterton's other project. And then Sailfish will repay the loan. Then, as soon as Sailfish owns this, it will vend the asset into Mako, subject to shareholder approval, in return for a 5-year gold stream, 4,100 ounces a year at 20% of the spot price of gold, subject to an effective cap at $3,700 an ounce. So at today's spot price, because we're trading higher than $3,700 an ounce, that means Sailfish will be entitled to less than 4,100 ounces per year. I think at today's spot, it's probably a little over 3,800 ounces per year at 20% of spot. And as soon as that 5-year gold stream is complete, then Mako will owe Sailfish a 2% net smelter return royalty on all mineralization coming from Mount Hamilton. So that's a lot of moving parts. But at the end of the game, what Mako has acquired over here is a fully permitted project. So this is construction ready. We actually intend to be breaking ground on construction by the end of March over in Nevada. We recently redid the resource. There used to be a full feasibility study that was put out in 2014. We took that with all the drilling that was done prior to then, and then redid our own geological controls and analysis over here, and put out a current resource of about 600,000 ounces. I put in the press release based on imperial units, but if you convert it to metric units, it's about 0.7 grams per ton. Which is high grade for an open pit heap leach mine. And then this is likely going to be scoped out as a 10,000 ton per day 2-stage crushing operation, figure a little over a 2-to-1 strip ratio. So effectively a little over around a 30,000 ton a day mining operation over at Mount Hamilton. And based on our expectations for metallurgy from a recovered factor, at those kind of head grades, this will equate to roughly 60,000 ounces of gold only, with a healthy silver byproduct on top of that, for what will initially be 6 to 7 years of effective mine life based on that resource. We do think that there's fairly low-hanging fruit, albeit you need to arm wave a little bit to get this to somewhere between 1 and 1.2 million ounces when all is said and done. The punchline is that Mount Hamilton was never a gold deposit. Never. Like in terms of where modern exploration began on this, this was always looked at as a tungsten deposit. It's kind of an interesting geology in its own right, in that you basically have two lithological units, both skarns. One that's situated on the top of the ore body that we call the upper skarn, and the one on the bottom that we call the lower skarn. The upper one was overprinted by a silver gold epithermal deposit. This is where the 600,000 ounces, and then with some arm waving, the 1 to 1.2 million ounces is located. And then these two skarns are separated by this 50, 75 meter wide hornfels unit that's not permissive for mineral deposition. So there's this barren unit in between. And then underneath it is this skarn, which contains, in our estimation, one of the largest and highest grade tungsten, we'll call it a target within the continental 48 in the United States. That being said, there was a feasibility and ore reserve. Take that with a pretty large grain of salt, because that ore reserve was put out in the late 1970s from a petroleum company named Phillips Petroleum, who was looking for exploring for tungsten to feed into their petroleum drilling business at the time for drill bits and whatnot. They scoped out a 6.2 million ton reserve at that point in time. There was over 30,000 meters of drilling. We have, in our estimation, all of the core situated intact at the facilities that we're acquiring along with this deal. So one of the first things that we're going to be doing is re-assaying that core and then establishing a more current economic, or I should say, a geological model associated with this that will show that this is actually an extremely advanced, large-scale, potentially strategic tungsten asset within the continental 48. So if you actually think about what Mako acquired, is that they have this 600,000 ounce resource. Let's call it something that'll be producing 60,000 ounces a year at deep first quartile costs. This will be sub 1,300 all-in sustaining costs when all is said and done. In our estimation, in the ground Capex will be somewhere between US 70 and US 75 million. With owner's costs, which includes a royalty buy down, we think the max cash drawdown to build Mount Hamilton will be somewhere in the neighborhood of US 80 to US 85 million. And again, construction starting in March. And at that point in time, we will wind up having a gold producer of about 60,000 ounces a year, generating, if you look at spot price, it'll be well in excess of US $160 million a year in EBITDA. And then that is not actually the largest and most important part about this acquisition. And we did all of this without issuing a single share, because the structure that we put in was that Mako is buying this with the help of Sailfish and Wexford, and structuring in a way where the only actual financial obligations are this gold stream and this net smelter return royalty that will only come into effect after that gold stream is fully repaid in 5 years.
Okay, so you gave a pretty good prelude, basically somewhat answering many of the questions I prepared, but I have a few follow-ups at least. So the just to clarify, obviously the debt remains with Sailfish. Obviously, it wasn't explicitly stated that that's the case, right?
So there's a bridge loan that's coming from Wexford that will get funded immediately prior to the acquisition. That bridge loan will be repaid by Sailfish through the sale of a completely unaffiliated royalty on Spring Valley. So Mako has no obligation to that bridge loan. Sailfish's big risk is can it sell Spring Valley, and can it do it at an attractive price? Sailfish has hired a very competent bank, a national bank in Canada, to run that sales process, which kicked off about 2 weeks ago. We'll see. Hopefully that will be the case. If not, then Sailfish will have to come up with alternatives. But that's certainly not a risk that Mako is taking. Mako's risk is with respect to the delivery into that 5-year gold stream. And then Mako's risk will be the project economics, assuming that 2% royalty kicks in 5 years from now as well.
Okay, and the location in Nevada, I mean, how far is it from Tucson, where you have your operating office in the United States?
It's a little over a 5-hour drive, straight shot. Vegas, not quite bisects it. Vegas is probably 3 hours away from Mount Hamilton, and let's call it an hour 40 away from Moss. So there's very little direct operating synergy. That being said, it's actually pretty easy to get to both sides by flying into Vegas. So from a travel perspective, bringing people around the world, obviously from a logistics perspective, both operations are pretty easy. The fact that we actually have this operation fully permitted is a big deal. There's a little bit of property that's privately owned and on BLM, but the vast majority of the land tenure is U.S. Forest Service. And U.S. Forest Service in the last 20 years is like, oh my God, you got the USFS through the Interior Department. Good luck. I don't have really a major major view of that particular situation, but the fact that this is fully permitted means we don't have to engage in that debate. Is that this is construction ready, and we can start breaking ground as early as the end of March.
And there are no other encumbrances associated with the company that's being acquired by effectively Sailfish. Initially, there's no debt or any other royalties outstanding in that company at all.
There's no debt. There are additional royalties. So a year prior to Mount Hamilton being permitted in 2014, Sandstorm put in a pretty clever deal with Mount Hamilton, where they purchased a 2.4% royalty for US $10 million.
Right.
And there was a clause in that where if this wasn't, because remember this was like ready to go, permitted, and going to be in construction. So Sandstorm put in a clause where if it wasn't in production within 10 years, they would get their money back, but retain the royalty. So 10 years from New Year's Eve on 2012, was that 2012 or 2013? One, I sometimes misremember, but it was definitely over 10 years ago. Is that cash payment was made, right? So Waterton actually had that obligation to repay that $10 million, but that 2.4% royalty exists. There's a 1% royalty on the property and a larger royalty on the property, but that does have a buy down clause associated with it. So when I refer to in the ground capex of likely being between 70 and 75, the real owner's cost, which includes likely pre-development exploration, or at least pre-production exploration, holding costs in general, or the engineering work that we need to get started. It also includes the likely royalty buy down that will be dealt at that point in time. So the initial years will be encumbered with at least 3.4% of a royalty, and that's going to be on most of the three initial epithermal pits, and then there will be 2% additional beyond that, beginning in 5 years' time.
Okay. So fairly encumbered by royalties, but that's the price you have to pay if you don't pay anything else, right, for an acquisition. So
Yeah, and then I mean, from a margins perspective, this can more than makes up for it, right? So there's plenty of room and meat. But yeah, like I think it's actually kind of unusual to have a United States asset not encumbered by some royalties, given the historical nature of how these wound up changing ownership over time. So for all intents and purposes, I would consider Mount Hamilton to be less encumbered than the most assets that you find in the region. But they're there, right? So,
can
and
you just clarify precisely what the buy down is? It's from 2.4 down to 1,
no,
1.4.
the 2.4 is there, and that's going to be what's held by Sandstorm, eventually by Royal Gold. There's a larger
Yeah.
royalty on some of the private claims that are going to make up part of the pits over here, where that private landowner will need to have a pretty substantive, not like a humongous, but a substantive cash payment in order to get it down to a pretty light level. So we're operating under the assumption that will be a royalty which is relatively significant, but not on the entirety of the property. It's just on a small piece of claim. Will get bought down, but that's going to have to factor into our upfront capex when all is said and done.
And that's a 1% or NSR. Is that the structure on that one, or is it some other
No,
structure?
it's larger, but with a buy down provision associated with it. The
Okay.
1%
So
is elsewhere.
where you get to.
Yeah.
So you can buy that one down to 1%, is what you're saying, hopefully.
The roughly, I actually think it's I have to so I have to get your viewers the exact amount, because I don't want to be misquoted, but it's going to be somewhere in that range. I don't think it's actually bought down exactly to 1%, but it's somewhere in that kind of range.
And the cost to do so has not been negotiated or fully sort
It's
of
contractual.
defined.
Yeah, it's
It's
contractual.
contractual.
Yeah.
Okay. Right. Interesting. I guess, and that's partially covering the gold silver mineralization, not
Correct.
fully, like
It's
some
not,
of the
it's
bit.
not on everything.
Okay. All right. I guess I should ask as well. So basically, 0.7 grams per ton gold equivalent, or something like this. That's a high grade heap leach. Can you just requote the expected recoveries you would see for that? You
So
said
this will be,
it's
yeah, it's pretty good metallurgy. So this will likely be right around 75% when all is said and done. Um,
Mhm.
unlike unlike moss, where we do have to deal with a little bit of a harder rock situation here, it's pretty straight down the fairway. We can get this operation with a two-stage crushing unit, get it down to about a half an inch, and that should be more than sufficient. And then metallurgy responds pretty well. Like even though there are trace elements of base metals even in the upper skarn, those pretty extensive metallurgy has been done over here, and they're pretty benign in the recovery process here.
Right. So the spot value in situ should be, let's see here, it has 75% recovery. So 60, like $70 at $4,000 gold, US recovered in situ value.
Oh,
Gold in
right.
situ value.
Yeah, yeah. You're looking
So
at yeah. It's
that's
somewhere.
good.
Sure. Yep.
And then sort of you just ballpark your thinking. So let's sort of capex. If you just break that down in your mind, you haven't officially published anything, but you've made an estimation of what you think this is going to be like. The operating costs, mining, processing. How are you thinking about all these things? The team thinking
Yeah.
about them.
So we have actually a really current example where it's going to be a very similar fleet structure to Moss. We're looking at a mining operation that probably will be maybe 20% larger, but not more than that than Moss. So it's actually a very similar uh, fleet design, and because the rock is easier to crush over at Mount Hamilton, we expect to have incremental savings beyond what we are getting charged over at Moss. So at Moss, at today's diesel prices, all in will wind up costing us around 275, maybe 280, somewhere in that range. And we do think that Mount Hamilton will get to maybe a 250 to 260 number. I think those are very real and current regional estimates. In fact, like most of our fleet over at Moss is coming from Nevada, right? So we do actually think there's a nice comparison between the two.
And
From
to
a
clarify,
process
you're talking about mining costs per ton now,
for
yes?
mining cost per ton, that's material move, waste and ore.
Yeah.
For processing, designing this at that kind of throughput, two-stage crush. So for instance, all in with the Merrill Crow system that we have over at Moss, that's running us right now at about $10.50 a ton thereabouts, kind of like from a processing perspective. That's three-stage crush, taking it to probably not a very efficiently designed Merrill Crow at the back end over there. Having this as a two-stage crush with an ADR, an absorption desorption recovery plant, you're going to be looking at processing costs that will be sub $7 a ton as well. It will be substantially cheaper than what we have over at Moss as well, and then the head grades are nearly twice as much. So it's a completely
Yeah.
different cost structure in terms of what we would have versus what we have over at Moss.
So just to clarify, when you say 275, it's basically $3, just below $3 for per ton and waste mining. And you said the strip ratio was 2.1 or
Yeah,
one.
it'd be in the low twos. So you're looking at something that will probably be in the context of around 30,000 tons a day from
So
mining cost.
15,000 of ore then, basically.
Yeah.
15,000 tons of ore. So you're saying basically, let's say $6 per ton of ore if you count the waste version. So half is waste, half is
Yes.
ore.
So
So two.
from a mining cost perspective, at
Yeah.
$3 a ton per unit, at a
Yeah.
2 to 1 strip ratio, so it'll be a little bit higher than that. You basically have 3 times 3 is 9. Let's
Yeah.
say for clean math, let's call it $10 a ton to mine a ton of ore.
Yeah.
To process that, you're probably looking at something that will be 7. So you're dealing with something that will look like $17 a ton. And then, as you said, from a net recovered perspective, so at 0.7, you'll need to get a net recovery. You're looking at probably yeah, you're right. So it's like right around $70 a net back from your revenue side of things. on the back of $17 marginal. You'll add a few bucks a ton for general G&A associated with it. So let's call it 20, then maybe additional encumbrances and overhead on top of that. You'll probably look at something that will be on the order, and again, these back of the envelope math numbers. Yeah, you're looking at something that likely will be in the mid $20 a ton of ore in the context of $70 netbacks over here. So when I do talk about all-in sustaining costs that will be sub 1,300, that's kind of how the math winds up working for an operation like this.
Yeah, you're going to make like 40, $50 though at the current
Yeah,
spot price
right.
per ton.
Yeah, I mean, like,
And
another way to look at it is like, look, we have like you have spot prices that are going to be 3 times in excess of what your effective all-in marginal unit costs are, which matches kind of like our little thought exercise on how the workup is going to be from a costing perspective. So yeah, I mean that's kind of how the math works here.
And then just briefly reiterate again that the capex, you're thinking on the capex, and then what the actual throughput of the plant will be. You said 30,000 tons per day
On a mining side, for
mining,
for
10,000 tons per day per
yeah, be about a
crushing.
10,000 ton a day 2-stage crushing unit. And yeah, no, this is kind of what the major skill set of our operating team is to design these small and medium scale um, mines and projects. And in fact, I think like for designing heap leach projects, this is specifically what Jesse's group has specific expertise around. So it really is. I put it in my quote. This is like right down the fairway of what we like to invest in. And then it just so happens to be that there happens to be potentially strategic critical metals. I don't want to call it a deposit yet, but at one point a reserve. At this point, it's an exploration target, but it happens to be like a potentially strategically sized critical metals deposit sitting right underneath in a marketplace where this has become. I've actually never seen anything like this in my career before in terms of what the not only investor appetite but actual government support appetite is for advancing projects of this size and scope.
I'll get back to that in a minute, but just the capex again. What was the capex for this $10,000 per day? Just in time operation.
We're pretty confident that we'll be able to build this for between just like direct in the ground capex. And then working capital that goes with specifically the project over here will be somewhere between US 70 and US 75 million.
Okay, that's a pretty precise range. So, and you've been doing what you've been saying you're supposed to be doing. So, we'll take that at face value. In terms of I mean, you're basically telling me you're going to make like $500,000 at current spot prices per day in operating cash flow, and 800,000 US per day in revenue. So you'll be at sort of a 200 million US revenue thing, or a bit more than that, and like 150 million EBITDA or something like this.
Yeah, like if you take a look at, so now we're getting from 3 angles over here, right? So I said at the beginning, I think it's going to be like sub 1,300. Then we did the thought exercise about what on the workup for the unit cost over here winds up being a little less than $100 an ounce that way. And then you look at it from an EBITDA perspective. I said at the beginning is that at a 60,000 ounce gold only with a health, let's call it maybe 5% of the revenue will be silver on top of that. So a low 60,000 ounce a year run rate at spot prices. This equates to something that will be in excess of US $160 million of EBITDA a year. Absolutely, yeah. That's kind of how the math works.
Yeah, but at least we walked it through, so it's a bit more clear, hopefully.
Yeah.
In terms of the timeline, you initiate your break ground in March. You're saying, what's the sort of the items that needs to be out of the way? It's just the transaction completion. Is there anything else you want to get done, like getting Moss fully sort of there before you, or what's the thinking on starting? And then once you're started, what's the projected timeline to get the build completed? And then maybe you can mention your thinking on financing potentially as well.
Sure. So, I mean, the urgent things are getting all of the access points kind of dealt with. So, improvements to road. It's actually pretty easy to get there from an infrastructure perspective. This is in a part of Nevada where there are operating mines around us. It happens to be a reasonably sparse part of the state as well. We will have some refurbishment of roads. One of the critical path items is refurbishment of of wells to make sure that that everything is clean running. We don't do anything to interrupt our the baseline work that's been done from the environmental side over there. So getting things from the initial infrastructure side, we're like champing at a bit to because think about this from a timing perspective. We don't own any aspect of this. This is still on Waterton's possession. As soon as Sailfish owns this, effectively Mako will take operating control of the asset, and so you get all of these things that are going to be done between now and when the larger part of the transaction will close, which will likely be in the second week of December. So all of those pre-development items will need to get done urgently. While all this is going on, is that we actually have a lot of work to do to finish our engineering on this. Right. So while this was there was quite a few iterations of engineering on this project between 2012 to 2024, is that we now need to kind of like do the work ourselves. So we spent about a year working with a private company that Waterton initially vended this into. But now we're going to have to do the real things with our crew on the ground. That likely will take about 4 months to complete. So we're going to be in a position where we'll have much more refined details of what needs to happen by the latter half of Q1 of next year. And then from our perspective, we're going to be ready to go. Start breaking ground by the very end of Q1. From a timing perspective, the way that we think everything is set up, it should take about 8 or 9 months to get built, thereabouts. So it'll take time to ramp up after that. You'll likely have first gold pour in early 27, and then it'll probably take a few months to get to something approaching steady state. But we're looking at trying to have first gold pour by the early part of Q1 of 27 over here. And then from a financing perspective, and this is kind of like the conversation that I've had with investors since we announced this deal, is that you can really look at everything two ways, right? So we ended Q3 after having particularly, and I mentioned this on the last call, we were having a scheduled and particularly weak Q3, just in terms of how the mine plan was working. So we ended the quarter with about $30 million of cash on the balance sheet. We had a scheduled and particularly strong Q4 coming up. So overlaid this with current gold prices, I expect to have our cash on the balance sheet in excess of $50 million by the end of the year. And then if you look at a starting place of 50 million, the cash flows coming from two operating assets, still put an asterisk around Moss, is that we were at 40% of nameplate capacity from a mining perspective for the last few weeks. We got a substantial amount of our fleet delivered this week, so that'll be in ramp-up mode imminently. And then by the third week of November, we're going to be at 100% of mining capacity, and then likely towards the latter half of Q1 next year, we'll be at something approaching steady state over at Moss. So two operating assets with an asterisk around Moss as of today. There will be a sufficient amount of cash flow to handle the $85 million max drawdown over at Mount Hamilton in its entirety. Looking at it in a completely bootstrapped way, where we don't actually have to issue equity or have any external financing to do it. Then, given the fact that Mount Hamilton is highly likely, 98+% sure, highly likely to jump the queue from Eagle Mountain over at Guyana, is that we're expecting to get Eagle Mountain fully approved on the EIA front in early Q4 of next year. So Steve was down at site over the last week and a half, finishing off our public consultations that originally was scheduled for July, but because of the accelerated elections this year, we lost that scheduling date until last week. So everything went smoothly, both with the elections and then also with the community hearings. So we'll take all of their questions, concerns. Again, it was pretty smooth to put into our EIA document for an end of January submission. And then we'll likely have that EIA approved, assuming everything goes smoothly by early Q4 of next year. Now, if we wanted to operate on a fully bootstrapped basis over here, we could, right? So you focus on three assets, wait for all three to get into production. build up enough cash on the balance sheet to be in a position where you can prudently start the construction over at Eagle Mountain. That likely will mean somewhat of a delay to the project, right? So if we get permits in October, I don't think we would be in a position where we would have enough cash resources to prudently start that until the back end of 27. The alternative is you could be in a situation where you can have external financing sources. I don't think the number needs to be more than, let's say, US 30 million bucks, but let's say US 35 max. And at that point in time, you can actually link all four together in a seamless fashion as soon as it's logistically feasible to get Eagle Mountain up and running. And in that circumstance, you can actually have all four assets in production by early 2028. And then if you string everything together in terms of how the production profile works for all four assets, you're looking at what will likely be in excess of a 200,000 ounce a year production profile.
Yeah, it's been a swift journey in the context of gold mining, that's for sure. But we established last call that obviously Eagle Mountain you can start the build before you receive the EIA to some extent.
Yeah.
Just getting debt financing might be troublesome, but I felt like you probably could do that or get sort of full financing if you wanted to, even though you didn't have the EIA in hand. But it sounds like with the addition of Mount Hamilton, you do not initiate much of that, at least any heavy capex, until you sort of are close to wrapping up Mount Hamilton. Is that like a fair assessment?
Yeah, well, it almost becomes somewhat moot if we. So we're not 100% sure that Mount Hamilton's jumping the queue. We're 98% sure, but let's assume that it's 100%. Given that, we do not have a team, financial or human resources, to build two projects at the same time. So yes. it actually does need to be scheduled out on that basis. Assuming that that's actually the case and it's scheduled out, that means the earliest that we could actually start building Eagle Mountain, and that's assuming that there's no financial constraints associated with it, would likely be the very, very end of next year. That being said, there's always like added flexibility of having this early works permit. Prior to the announcement of the Mount Hamilton transaction, we were highly confident that even though our expectations were not going to be getting a full EIA approved over at Eagle Mountain, is that we were going to be in a situation where we can conceivably start construction on the civil works and even a substantial amount of the plant in the May-June context. This one, it's nice to have that flexibility, and if for whatever reason there is a delay in the EIA beyond October, it's actually nice to have that flexibility because it would still apply. But it almost becomes moot if Mount Hamilton goes first.
But basically, end of year, you expect to be 50 million cash on hand, and you'll initiate this in March. So you might even have reached the full 70 to 80 million in cash at that point in time. Probably not, but the debt required is really small. It's like 20 million bucks maximum you would need to get in there.
Yes, and let's take a look at it from a debt perspective. So Nicaragua is a controversial jurisdiction. That being said, it's actually pretty easy to mine there. Our experience has been great, seamless, clean for everything, the good and bad that comes with the country. One thing that's unequivocally negative about Nicaragua is that you really do not have large, diverse alternatives for debt-based finance coming from the outside. Basically, with the exception of some minor stuff, it's a cash business. You can see it on our balance sheet. It might seem like we're building our business intentionally with a fortress balance sheet. It's not intentional, or at least it's been intentionally foisted upon us to run the business that way. Moss, because we're right now in a process of updating our reserves and pre-feasibility study, any potential bank lender will require that being a starting point to come out. So we're expecting to have the Micon report out in the middle of December, in which case I do think that financing discussions can happen with that as a starting date. So that is definitely a possibility for next year, just not immediately in the context of October. And then in a very similar fashion, and we're going to be approaching it in a very similar way to Mount Hamilton, is that even though there was a feasibility study done on this, bankable feasibility study done on 2014, our resource statement over here has superseded that. So right now, there's no current economic study on Mount Hamilton where every bank lender will require that. And in a very similar fashion to Moss, where immediately, even though there's a lot of stuff that we were doing on the ground to refurbish and get everything up and running with our own internal group, we were also working in the background of getting everything ready. But at the end of the day, is that it would really required about 10 months of work to get a realistic reserve statement with a pre-feasibility study out, which is still scheduled in mid-December. A very similar thing will happen with Mount Hamilton, where I don't think we're going to have that until early Q4 of next year as well. After that, then great. I think we're actually going to have a lot of access to debt capital and things of the sort after the fact. It just so happens that right now we don't. And then likewise, from our Nasdaq listing, I am relying on a certain regulatory framework for the TSX venture to complete these deals. So we can't do the listing until every part of this transaction is closed. So the Sailfish Waterton part will close pretty quickly. The second part between Mako and Sailfish will require bilateral shareholder votes. So I don't expect that to close until mid-December. And if that's the case, then we can potentially list on NASDAQ. We're going to be submitting our application to them imminently. We should be able to list sometime in January, so pretty immediately thereafter. That being said, I did make a promise to NASDAQ and our insurance providers that we're not going to be doing any material financing around then. What around then means is subject to a debate, but I would imagine that we're not going to be looking at large scale material financings between, let's say, December and February, thereabouts. So the question is, do we take care of our full balance sheet across all four assets now? Do we do it later? Do we bootstrap? Everything is a choice. And then it really is just going to be a question as to what the right choice actually is.
Well, it's good to have the option to decide your path anyways. That's the strength to be highlighted here. I think we'll leave it at that for now, Akiba, and we'll return to this before year end again when we have some more documents, I think in December sometime. But I did want to ask you again, because you mentioned you believe you can expand, basically double the resource here. And we'll discuss with the geos probably next time what that actually looks like. But the geological potential is substantial just for the gold, silver mineralization to expand in your view. Maybe just give a few comments on that.
Yeah, I mean, it looks like, so right now the mine plan that existed in the 2014 feasibility study and the pit optimizations that existed in this resource update were on three pits that actually look like the same structure. So I do think eventually with some infill work, there's a reasonably high potential that at least a couple of these pits are going to converge. So there's going to be low-hanging fruit just by doing some, can't even call that infill work, but let's call it in the context of what we know about expansion work. And then we do think that there are geochemical showings to the south in this area called Chester, which is actually where one of those buy-down royalties are located. And then also to the east to a certain extent that are showing very high-grade geochemical anomalies that are very similar in type to where the main mineralization is. That I do think there's data to support with a drilling program, something that you're going to be able to find more. So we do think that the exploration potential here is likely going to be in that 1 to 1.2 million ounce range. But it needs to be drilled. So that's going to require some exploration success. But it is exploration success that we can quantify based on real data that exists.
And all of those targets would be within the realms of the exploitation sort of permit.
With respect to the plant and infrastructure, that's true. With respect to moving another pit out, will require likely an amendment to some of our permits. I don't view anything to be even on this. So there's in terms of some of the design work that's been done in the last 10 years, there were some optimizations that went outside the 2014 permitted area. That if you wanted to go and run this for the full 7 years, it likely will require also a permit
Yeah, yeah.
amendment, even starting in year four and a half, five. So there are aspects over here where it's not like you can run this from a completely static perspective, not worry about the regulators or the government from a permitting perspective at all. That being said, the hurdle rate of getting a permit amendment is low in general and under any administration relative to what it's like to get a new one. And certainly from this administration, it's a completely different ball of wax. That being said, from the initial infrastructure that's going in, initial mining that's going in, construction ready, we can start the second we actually get our hands on this.
Yeah, I mean, it's an issue of mine life. You just
Mhm.
repo. You have plenty of time to do that, so it's not a critical item, I guess.
Mhm.
And on the tungsten, molybdenum, copper mineralization, this is interesting. I guess did you have 30,000 meters of historical drilling just on that? This is not including the silver gold mineralization, I presume.
Yeah, I think it's amazing that we have the core intact. So we have boxes from Phillips dated back from 1969 in the
Do you have drill locations as well?
yeah, exactly. I wouldn't trust any of the core for metallurgical purposes, just because it's been sitting out for 50, 60 years. But for a reassaying perspective and basically getting our hands on doing a basic model, I think we're like extraordinarily advanced for what this actually is. And we kind of sort of alluded to it in the press release that we put out. So even though the tungsten aspect is not permitted at all, right? So the mining of tungsten is not permitted, and obviously this would be completely different plant design, right? This is not going to be
Yeah.
a crushing unit, heap leach, and an ADR recovery process. This will be a flotation, dense media separation, and then back end APT plant. Completely different on both fronts, and will require a lot more capital than 70, 75 million in the ground in order to build it. That being said, just by the very nature of this target, but at one point it was a reserve target, being situated immediately underneath a fully permitted gold and silver project that will be a mine in the course of the next 15 or 16 months, makes this more advanced than just about anything else of this size and scope that you'll find in the continental 48. Just because the ability to get a permit on something that's already in operations is just that much easier.
What's the vertical distance between the bottom of the gold silver oxide mineralization or heap leach mineralization to the start of the
Yeah,
polymetallic?
it depends where you are. There are the parts of the ore body that it's as small as 30, 40 meters, and then there's it widens out, and then the lower skarn kind of pushes you to the southwest, where we don't have any gold on top of that, at least that we know about at this point. So it really depends where you are.
But certainly you think this would be some sort of underground. I mean, it's sub 10 million tons, high grade. If you equate it to copper equivalent,
Mhm.
it would be underground. There would be no potential to extend the pit and get the gold silver pit. I mean, that takes too long. I presume you wanted to initiate this earlier, anyways.
So based on what we've seen, I think that's likely. I wouldn't call it definitive. This The lower unit does appear that there is potential for it to have daylight, likely on parts of the ground that we don't control right now. But
Mhm.
I wouldn't give it a 0% probability that all of this is an open pit. But certainly the data that we have right now, I do think is supporting an open pit gold and silver mine and a likely well into the future underground tungsten mine. I think you need to underwrite on the basis of that, but it's not definitive by any stretch.
And how are you thinking about the in situ value of the rock here? I mean, we have the historical grades. What is it? We have basically zero point 0.4 tungsten, zero point 0.4 molybdenum, and say zero point 0.6 copper. What's your take? I don't know the spot prices now, but I think moly is trading at what is it, 40,000 per ton. Copper, call it 10,000, whatever, and then tungsten is trading at what right now?
Like in the high 60,000s these days.
Okay.
It's traded usually in a unit that's 1/100th of a ton, so it's about 660, 670 free on board. Uh, from an APT perspective in China. That being said, the way that we're approaching the tungsten, even the private company, um, wound up getting allocated a grant, so single digit million grant as part of the last bill to help do some of the exploration work over the tungsten that they needed to not accept, right? Just because they defaulted on the option agreement, they don't own that. I'm assuming it's going to be relatively low hanging fruit for us to get similar levels of support, and then on the larger side, the it's I'm trying to think like how best to describe it these days is that you almost can't look at this exactly like an in situ value and an underwriting perspective like you would a traditional mining project, just because the government has at least given indications of template type investing to incentivize the operations for these critical metals deposit. It's a
Yeah.
too early to define economics on it, and then B, to the extent that even if we were to define economics on it, I'm not entirely sure that would necessarily be relevant to the environment that we're working in right now. Is that if you're looking at this as a strategic asset, then almost all bets are off in terms of what this is going to look like. But the first order business is first. Is we gotta do the basic work to see exactly what did Phillips leave over here, and then we have that information. It'll still take quite a few months to put that basic stuff together, but that's going to be a starting point to define, well, what exactly are we going to look at here? What elements of support are we, because normally, I mean, you've seen how we've done business over the last six years, is that we get things up and running, generate cash, and then at that point in time, it's actually fairly easy to allocate capital to greenfields exploration type or brownfields exploration as well, type activities. We would do the same thing over here. That being said, if there's an opportunity to accelerate that with government support, then we're all ears on seeing how that would be mutually beneficial.
But I guess the template so far, look at Stibnite and some other projects with antimony or whatever, different metals, it's usually just grants on the Capex side, just easing Capex so far. There hasn't been any, I haven't seen, maybe I'm just not paying attention close enough, but I haven't seen any sort of fixed takeoff agreements that are higher than spot or just to secure
And
supply.
there's been a major one like over on the rare earth side. Absolutely, there's been a 10-year price floor take or pay with Mountain Pass on the rare earth side of the equation. I view tungsten from a level of criticality, at least on a percentage of supply demand that's out there, to be as critical as heavy rare earths are, at least from a mining side. Processing might be a different beast. So you never know. I mean, it's a new world, and we have to explore what opportunities are there. I mean, but the reality is that I don't know, right? So my position is that we're pretty confident that we have something that has strategic value sitting underneath something that has actual quantifiable permitted real will turn into cash flow value, and then it's just a question about how do we actually put the contours around turning the strategic value into actual like real value with respect to what it means to make us shareholders.
But basically, I mean, if you look at the in-situ value, the recovery is just a question mark. I have no clue what one could expect. But you have, let's say the tungsten is that's $60,000 per ton. That's 600 per 40% dollars. 42. That's 250 or whatever. And then you have the moly. That's 40,400 at point four. That's 160. Not accounting for recoveries. Then you have copper. That's like $50 or whatever, something like this, for the point six copper. So add that together, you're $400 to $500 pre-recovery, and then I don't know, maybe you can take like a 60% recovery conservatively. So you're still at like $250 $300 per ton
Could
recoverable.
be.
So it's a good underground to
We
know.
were going over the back of the envelope for Mount Hamilton, trying to think
Yeah,
what's on the back of the back of the envelope. It's like on looking at the back of your neighbor's envelope at this point. At this point, it's too early to quantify. The one thing that we can quantify is that this is a target that has the size and the grade where this could potentially be a strategic asset that the U.S. government would want to see in production as
The
quickly as
point
possible.
being, it's not like it doesn't necessarily need to be subsidized because the in situ value is within reason mineable for
True. Yeah,
100.
yeah. No, like even going back in the context of 2014 when we were looking to acquire it, like the people that owned it, said, the tungsten's worth more than the gold. Like so, and that was at a point in time where the tungsten was trading like around $23,000 a ton.
Yeah.
I viewed it in 2014 as like that's an interesting factoid. I also don't particularly care. Now it's just a different world. It's a completely different world than what existed 10 years ago.
And you believe there's expansion potential based on the
Yeah,
geological interpretation to expand the 6 million tons?
yeah, absolutely. The host rock over here has all the potential in the world to be a multiple of what was actually delineated by Phillips. Yeah, no question about that.
So finally, before we wrap, then, so just plans moving forward. I mean, how much drilling do you want to do here next year? Do you hope to get the drilling perhaps subsidized by the US government? When could that be
Possible.
initiated?
Yeah, it's possible. It's also possible that that subsidized drilling that is specifically designed for the tungsten could also help with expansion and infill work over at the gold. I mean, all of those are options that we'll explore. First order of business is that we need to get operating control of this asset, which likely will be in 2 weeks. But all of those pre-discussions have been happening with the White House, and then we'll continue those discussions once we become the actual operator on this asset imminently.
Okay, so we'll check back in on this before you end again and talk the other assets. But thank you for your time, Akiba. Good update. Sure, everyone will appreciate it.
Okay, all right, go on. All right, take care.